Welcome back. Let's go to a market expert to talk about the impact of the election of Donald Trump and a potential trade war involving China and other partners, including perhaps this partner, Canada. Jeffrey Kleintop is Chief Global Investment Strategist at Charles Schwab. He joins us from Celebration, Florida. Jeffrey, thank you a lot for talking to us. A lot of people are astounded at the rally that we've seen in U.S. stocks and on some global stock markets since the election of Donald Trump. But a student of market history like yourself is perhaps less surprised.
Yeah, stocks are off to a typical start, Paul. Despite the uncertainty posed by a new administration, global stocks have posted gains in every transition period, from election day to inauguration day for a new administration over the past 50 years, unless we were already in a recessionary bear market, as we were in 2000 and 2001 when transitioning to the Bush administration, and 08-09 as the Obama administration was transitioning in. Now, we expect continued economic growth heading into 2025, similar to all those other past transition periods that featured gains for stocks.
If you talk to economists, they are concerned about a across-the-board tariff wall being erected in the U.S. There was a editorial in the Wall Street Journal, I'll say 3 or 4 weeks ago, in which it said this will, no question, raise inflation in the U.S. economy. And I think many economists are of the same view. Why are markets seemingly less concerned about that prospect?
Well, while there's been talk of a combined proposal of 60% China tariffs and 20% across-the-board tariffs on all our U.S. imports, we don't think that is likely. We think, and I think this is what the market's hinging on. Trump's, of course, threatened very high tariffs on China in his first administration, actually end up making that phase one trade deal, and of course threatened to end the trade agreement between Mexico and Canada and the U.S. in his first term, but ultimately forged the USMCA agreement. So more likely tariffs are a starting point for Trump negotiations on a trade deal rather than an end point. But I'd point out, if you look at the impact of a trade war, and the IMF in their recent World Economic Outlook did just that on pages 23, 26, and 27, they really dug into a trade war scenario for 2025, and assuming 10% U.S. tariffs on all imports, plus full-scale retaliation by Europe and China, resulting in 10% tariffs on U.S. exports, and on tariffs between China and the EU, the impact on global economic growth next year was only to shave 0.1% off of global GDP, and a negligible impact on inflation. So perhaps a more realistic trade war scenario isn't as dire for growth or inflation as maybe some investors might fear.
Is there a, is there a preference, is there a history, rather, of investors preferring companies with sales in the United States versus companies, large multinationals, for instance, that have a lot of their sales derived from outside the United States? We hear a lot about the rotation into smaller cap stocks, and many of those smaller cap stocks are U.S. only in terms of where their sales are, or certainly predominantly U.S. Is there a reason to believe that investors may come to favor companies with a domestic sales base?
No, there isn't. And in fact, if you look at the first Trump administration, it was widely thought that small cap stocks would perform better than large cap stocks because of that focus. That did not happen. Small caps were roundly trounced during the first Trump administration. And emerging market stocks, which are thought to underperform because of their trade exposure with the U.S., actually outperformed in the first 2 years of the last Trump administration. But more importantly, stocks with high foreign sales exposure have performed very similarly to those with no foreign sales exposure. Since President Trump's 2016 campaign, we really haven't seen much of a difference between those companies with a lot of dependent on foreign sales and those that don't. It really is the economic backdrop that seems to be driving these firms collectively rather than their relative trade exposure.
Of course, during the first Trump administration, he began by threatening steep tariffs. He enacted some steep tariffs. We were very disappointed in this country to find ourselves on the receiving end of a tariff on our steel and aluminum based on national security concerns. That created outrage in this country. But the story ended with a new trade agreement reached between the U.S., Canada, and Mexico. And there were new trade agreements after similar threats reached with other countries as well.
That's correct. Now, one of the concerns is, of course, Canada still remains very exposed to U.S. from a trade perspective, as 75% of Canada's exports go to the U.S., and so that remains an issue. The USMCA agreement is up for review 6 years after it was put in place. That will be July of 2026. So there is a threat of maybe renegotiating that deal as we move towards it in an environment that's generally globally less friendly to trade.